everybody. Welcome to another episode of the Building Your Own Economy show. And today's guest is going to be fantastic. So if you're into real estate, if you're into investing, like I'm pretty sure that's why you're watching this show. If you want to know more about tax strategy, and more importantly, you want to know about investing in Southern California, this is the guy you got to talk to. We're going to talk tax strategy. We're going to talk investment strategy. We're going to talk about the real estate market in California and real estate as a whole. You know, we got Jason Lee here from JLM Real Estate. Welcome, Jason. All right, Jason, man, how are you, man? Welcome to the show. How are you?
Hey, thanks for having me. Good to be here, David.
Good, man. So you're in San Diego. What's it like to pay the most freaking taxes in the country?
Well, California tax, it does suck. And, you probably know this. You can't get away from it, even if you depreciate and cost segregate your properties. So,
yeah, because the state tax return doesn't like that shit.
Nope, they do not like that shit. So I'm paying 12.1% no matter what on my corporation. So that sucks. But the weather is beautiful. It's always 70 degrees and sunny here. So, I got to pay the sunshine tax.
It's interesting because, I visit California frequently for business and events and things. And when I go, I'm like, all right, I can see it. I get it. Especially San Diego. I get it. It's beautiful there. So one of my best strategies for people who live in California for tax savings is to move out of California. And and typically, honest truth, a lot of my clients move to Nevada, and they'll move to Vegas because Nevada's got better tax preferences for business owners. Number two, there's a lot of amenities that you can get in Vegas. It's a pretty robust area. It's got a lot of commerce, and they can drive to places like San Diego in just a few hours, which is pretty cool. So, just sharing that with you, man. So tell me what you do in California. Tell me about what do you do?
Yeah, so I'm the principal, CEO at JLM Real Estate. JLM Real Estate is a multifamily brokerage focusing on representing buyers and sellers of multifamily properties in San Diego County and the rest of Southern California. We do a little bit of, triple net lease sales, retail sales when our clients want to exchange into a more passive kind of asset. And then my other side of the business is, I'm an investor as well, like yourself, David. I started by just buying my own deals and flipping them and 1031 exchanging into larger assets. But I recently started partnering with, LPs on developments down here in San Diego as well.
That's really cool. How old are you?
Guess how old I am. How old do you think I am?
You're somewhere in your 20s. I guess that shit. So how old are you?
I'm 26.
Yeah, I would have said 25. I didn't want to make you feel too good, bro. So how long you been a broker? How long you been a broker?
Since I was 20, so it's been about 6 years now.
Really? So in Texas, where I reside, typically you have to work 2 years under a broker and then have a number of transactions under your belt. Is that how you got your broker's license? Is it the same in California?
Yeah, it's the same. You got to be an agent for, I think, at least 3 years here and do a certain amount of transactions. But yeah, I was under a boutique brokerage here in San Diego. That's where I got trained and was mentored by my old broker. And then I started my own shop in 2021.
Were they happy about you leaving?
They were not stoked. They were not happy.
Well, I by the way, I actually held a real estate license in Texas. I got it back in 2006, and I held that for about maybe 6 years. I never pursued my broker because during that transactional period, that 6-year period is when the market shifted, right? Recessionary period. And, quite frankly, it was very hard to be an agent or a broker at that time. And I thought, man, getting a broker's license just doesn't make sense. And I always aspired, though. When I got my license, I was actually 22 or 23. And I was like, man, I'm going to be a broker someday. And it never panned out because of the market. So I actually admire what you've done, especially at a young age, because that was kind of like my aspirations at your age. And congratulations, because that's really cool.
Thanks, David. I appreciate it.
So somebody comes to you, you are a broker. I'm assuming you have agents, you have a team. You guys are only focused in multifamily, and you said maybe triple net stuff, commercial lease. So basically you're in really commercial real estate. Would that be fair to say?
Yeah, we're in commercial real estate.
Yeah, because multifamily, even though it's considered, we call it residential, it's not really residential. Most people don't buy a multifamily unless they're, a fund or have a significant amount of capital. And you said, so did you start by investing in real estate and then get into the multifamily? Like, did you start with single family, or did you already go straight into multifamily? How did you start?
Yeah. So, when I was 20, I had no money. I don't have any family money. I come from a very humble background, lower middle class. So I made money by selling multifamily properties. It was not an easy journey for sure, as you probably know. Probably got rejected over the phone like 1,000 times before I got my first lead. But I saved up some money that way. So I started selling small multifamily, like fourplexes and 8-unit properties. And then my first property that I bought was a duplex. And then I kind of worked my way up from there. So I've actually never bought or sold. Well, I've sold one single family home for a client, but yeah, never owned a single family home.
Really? So you just went into the big leagues right away, huh? Well, so I would imagine you call it, so for audience sake, multifamily is it's a very interesting marketplace, especially the dynamics that there are people who've been in this industry or in that particular asset class for decades. So you're coming into that asset class as a broker that even if you had a lot of experience in those 5 or 6 year period, you're still competing against a guy who has relationships that are very deep and have been established over decades. How do you compete in that environment? Because it seems to me like there's like let's just use a number. Let's say 100 real multifamily brokers in the country, like that are like the guys to go to. How do you compete against that?
Yeah, that's a great question. I think I personally think that the older investors the biggest investors in my market, they've been in the game, like you said, forever. And, they're not really working. They're out on the golf course, they're traveling, they're waiting for one of their brokers to call them, and they're probably working like maybe, a couple hours a week. But, I'm in the trenches 60 to 70 hours a week. So I feel like I have to find a deal, before then, because I'm working 20 times as hard as they are. So even though they have the relationships, I'm still working on building my book. But along the way, I've found some pretty good deals and made some great relationships with other brokers in my markets. And it's been panning out really well so far.
That's really cool. So how do you find the leads for listing leads and for investing leads? How are you finding them? By the same avenue, the same lead source? How are you doing it?
Yeah, so it's a little bit different. So the investor leads kind of came organically. So I'll start the listing leads. Listing leads, we pull lists from the public tax records, and we're just, cold calling all day long, reaching out to them, sending mailers. So old school. And as I've gotten listings, as I've, closed deals, I've made some great relationships with brokers in my market. So those brokers have actually, given me pretty good off-market deals. I told them I was looking, I had capital to place. And, over the last 4 years, me and some partners and brokers have built some great relationships. So the investing leads kind of came organically from building good relationships through brokerage. If that makes sense.
Yeah. And so for your listings, same thing. You're saying that comes from the cold calls? Is that what's...
Yeah, that all comes from, a little bit of, I'd say a little bit of like social media stuff and digital marketing, but most of my leads have been from just banging the phones.
Yeah. Or like, I'm assuming you're using CoStar and just pulling database and then just seeing what transactions that happen 3 to 5 years and then flipping that. That's the normal and standard. So like, are you focusing on a particular demographic, or not demographic, geographic? So are you looking just in California, or are you looking at assets all over the country?
Yeah, so we focus specifically on Southern California right now. I do plan on expanding into other markets, but I don't know if we're there yet. We're only 2 years old. We've done a lot of deals. We've done about 300 million in the last couple of years, but wow. I don't think we have enough market share in our market to even like consider restarting in like Phoenix or Vegas or something.
Yeah, that makes sense. So you want to dominate, the backyard before you take out and get out in the front yard, right?
Yep, exactly.
That's really cool, man. So you have investors that come to you looking for deals. So tell me, like, what is your understanding of the like the tax implications for an investor when they come to you? Because I'm very certain that they all ask you that. How does
Oh yeah, that's like the number. That's like the number one objection rebuttal when they sell is like, if I sell, what am I going to do with my money? Because I don't want to pay, 30 to 40% capital gains on my, gains the past 10, 20 years. So,
So well, that's for the seller. That's a good, let's start there. So if you go to a guy who says he wants to sell, he's going to see let's call it a $5 million, gain or greater. What is it that, you tell them? I mean, how do you persuade somebody to take that on? That's a better way to state it.
Yeah. So, I mean, we never advise our clients to cash out, unless they absolutely need the cash for like an emergency or they're completely out of funds. But we usually advise them to either, do an exchange, a 1031 exchange into a larger multifamily, or if they're sick of managing it and they really hate the business, we steer them to defer capital gains taxes and exchange into a more passive vehicle like a DST or a triple net lease property.
Those are not bad suggestions, by the way. I think that's a really good statement, helping them figure that out, because that is the number one reason most people don't want to sell an asset, especially if they've held that asset for 20 or 30 years, which is primarily the ones we want, right? Those are the guys out there that have more of a reason, an incentive to sell. They've been either sitting on something that needs a lot of rehab now, or they're sitting on something that, well, they don't have any real succession plan, meaning somebody's not going to come and take it from them, so they have to exit in some cases. We acquired a property a year ago from a guy that was doing the same thing. He was just like, I'm tired of working this property. I mean, it was a $7 million deal, but the guy was like, I'm just tired of it. And he had owned it for 30 years,
Wow.
30 years. So he was going to get a nice capital gain. I mean, and we helped him through that structure, which was really nice. But so what about the opposite, though? What about from an investor standpoint? So I come to you, I want to work with you. I'm about to put my money. I got $250,000. I'm assuming you're only working with accredited investors, and I want to park my $250,000. What's you going to tell me about taxes? I want to know what your spiel is.
Well, David, I mean, usually when people ask us about taxes, it's because I don't want to get sued out on my license here in California. I just say, talk to your tax professional. But if they really keep digging on me on the tax implications, I mean, if you're buying an asset, I mean, tell me if I'm wrong. I'm not a tax professional.
No, by the way, this isn't to put you on the spot. It's more so because this is something that I see all the time. So I'm just wondering what you say. You could be right or wrong. It doesn't matter. I'll actually not going to grill you hard on that.
You can put me on the spot all you want. I can take the pressure. So, I mean, usually, I think this is your question. Like, you're asking me if someone has $250K to park into a property, you're asking if
they're going to ask you, what are the tax benefits to this? What do you?
Okay, yeah, the tax benefits, yeah. So, I mean, talked about it before the show. Owning real estate is a huge tax benefit because most people don't know about the benefits of cost segregation and depreciation. So, we always recommend our clients to get cost segregation studies, but if they buy $1 million property with the 250 and they like it and I bring it to them, if they buy it in 2023, they can write off a significant portion of the building value, not the land value, after they work with a cost segregation specialist. But that bonus depreciation is actually coming down every year. I think right now it's like 80%. Next year's gonna be at 60%, then 40%. So that really sucks for me and other investors. But I mean, if you have your own business and you claim that you're a part-time real estate professional, say you manage the properties, I think it's at least like 10, 20 hours a week or something, right?
You're getting close. You're good. Keep going, man. You're good.
Then they can actually use all the bonus depreciation. So let's say you buy $1 million property, the building value is $700,000. Let's say you do a cost segregation study. I mean, I did that study, this year on a property, and I think I wrote off somewhere around like $275,000 or something like that from a cost seg study. So pretty good.
Okay. By the way, you're very, very, very close. Not to say you're wrong at all. Actually, everything you said. The only nuance to what everybody needs to know. And by the way, the reason I ask you this question is one of the reasons that I started to help people, and that we're engaging now with some of our clients to help them invest their money in different assets. the reason that we started that engagement, it wasn't necessarily because I wanted to do that. That wasn't our primary intention. Our intention was to help people with tax strategy and investment strategies that would offset their tax obligations. The challenge was that I would tell a client, hey, you should go talk to somebody about this, right? And I would say, hey, go talk to somebody who could, let's go talk to, let's say I said, let's go talk to Jason, right? Let's go talk to Jason. Jason's your boy. He's got Southern California. He's got all these assets. He could do it, right? So I sent him to you, and you would go and they would say, yeah, Jason, I got $250,000, help me. And you'd say, I got this perfect opportunity. You bring him into the pipeline. They make a commitment. And then, 6 months down the road, they'd come back and they say, yeah, here's the K1. Jason gave me a K1. It's got a negative on it because we did a cost seg on the deal. And I'm like, perfect, whatever. But the point that would come across is that they didn't actually understand that there are minimum requirements of participation, what they call material participation. And it's typically, that's the hindrance from offsetting current liabilities. Like, you can't offset your tax liability by using a passive investment strategy. That's the challenge. And so the reason I illustrate this, though, is because there are many syndicators and there are many funds and groups out there that are taking money from investors and explaining to them, yeah, there's all these tax benefits. And then they'll just say, and the client will say, well, what is the tax benefit? Oh, you talk to your CPA, he'll know. That's what they all say. And that, by the way, that's not wrong to say. It's just that they go to a CPA or a tax professional that doesn't know shit either. And so they're caught into a transaction. Like, for an example, if they went with you on a 250 and they think that's going to offset their tax obligation, at least in some way, shape, or form, it doesn't. And so now they've put 250 into a deal, which is good. They've got equity into a transaction. It could build wealth. There's an exit in the future, but the offsetting of a current liability doesn't occur. And so now they still have the same tax challenge, but with less money in their pockets. I see this like literally every day. And and the reason I brought this to your attention, by the way, for our audience, is because, Jason's doing his best to educate his clients, but everybody should work with a tax strategist that helps them understand this, because if you don't, you would be in that situation, which most people get into, which is they invest in real estate without actually knowing the guidelines by which they need to follow. And Jason, to talk to the 10 to 15 hour or 10 to 20 hour thing, that is true. But the next nuance is they must participate in real estate more than half of the time if they have other activities. So if you've got a guy who makes a shit ton of money because he's a CEO of a company, or he's got his own business and he's spending 100 hours a week in his business and he's investing alongside you, he cannot justify hitting the status, because even if he could spend the 750 hours, which is required, he still doesn't have half of his time in the real estate transaction. So it's virtually impossible for him to do it. And I'm only sharing this with the audience and you is because I want everybody to know that if you don't know this stuff, you get burned. And it sucks, because a lot of clients will come to me and they have invested a shit ton of money in a deal, and then they still have a tax bill and they're like, well, why did I do that? Why did I do that? Now, that doesn't mean that the deal that you got them into or that the syndicator or fundraiser got them into is bad. To be very truthful, it won't be bad, because they're going to probably receive distributions throughout the years. That could be maybe not year one because of capital expenditures, but maybe years 2, 3, 4, 5 until the exit. There'll be a trailing, let's say 6%, that won't be taxed because cost segregation would have wiped that out. In addition to that, the exit in the 3 to 5 year plan, or whatever the plan is, typically that exit capital gain will be offset by depreciation, so they won't even pay taxes on the exit. But they didn't get the immediate benefit, which they're working towards. Does that make sense?
Yep. No, it makes perfect sense. But if you are an active real estate, if you're active full-time in real estate, then you can write it off year one.
Oh, yeah. But so that's very true. But I find that's very rare and far in between, because the vast majority of people who have, if I have $500,000 sitting on the sidelines to do something with it, I had to have earned that somewhere, right? And that means I probably have a business or a job. And that's probably how I got the freaking cash to begin with. So it's going to be very hard for me to offset my income by claiming I'm a real estate professional. It's just harder. That doesn't mean it's impossible, but I would venture to guess if you met with 10 people today that had $250,000 to invest in one of your deals, maybe 2 would actually qualify. Maybe. And I would even say as much as 1. It's very hard. So you have to, and by the way, they're mostly not going to meet it because they're LPs anyways. They would have to be a GP because, I mean, that's the only way you can actively participate. As an LP, you just shut the up and just take the game, you know?
Yeah, exactly.
So, I mean, I get the game, and that's why I was asking you that question. So somebody comes to you, you talk to them, you give them the guidance. I mean, what kind of assets are you looking at right now? Tell me like the asset class you're looking at to invest.
I mean, we strictly believe in multifamily because we think, especially in San Diego, let me tell you a quick stat here. Sandag, the biggest San Diego housing analyst, they do a study every single year on the supply of housing, the housing market. And for the demand of renters that need housing in San Diego, we're over 70,000 units behind. And the last 5 years, we've built like right around 5,000 units every single year of new supply. So
We're still behind.
yeah. So I mean, and the housing market's correct. Like, let me tell you something. Like one of my agents, he also does a little bit of residential. He submitted an offer for one of his clients, and they had 50 offers on the house. So the market here is crazy. People need housing here. So if you buy a property for a good deal here, you're not going to have any problem renting it and making income. So we're still very bullish on the multifamily market. Office, retail, not so much, but industrial is also a very strong market here in Southern California.
What's the buy box? Do you guys have a dollar or maybe unit size that you're looking for, or?
Yeah, I mean, for myself, well, for clients, it kind of ranges depending on their goals and their needs. Some clients are looking to grow fast, so usually they want, properties where they can add value fast and, turn the units, raise the rents by 30, 40%. Those kind of people are typically younger investors in their, 40s. And then the other demographic is, people that just want to preserve their wealth and park it somewhere safe. So they'll buy like the low cap rate, fully rehabbed properties that are in trophy locations just to protect their net worth. And then for myself, I'm the first kind of person. I'm looking to grow fast. So I'm always buying properties to fix up, do the work, big projects. And then also, we're also doing ground up developments, like small 16 to 20 unit developments around San Diego.
Are you like the handyman too? Do you go out and do those rehabs, or you got a team?
Definitely not me. I'm just the deal guy. I'm good at finding deals. I'm good at connecting people, but I'm a terrible operator. So I have a partner who helps operate the deals.
That's funny, man. Every time somebody asks me that, I'm like, I'm an indoor dog, man. Like I'm the guy you can't take me outside to work, man, because I'll melt. So I don't do the handyman stuff, but I definitely know how to find deals. I think we have a commonality here. I find the deals. I know how to vet the deal. I know how to fund the deal. I know how to do the transaction. But if you ask me to go put in the windows or fix some shit, it ain't happening. Like that's not going to happen for me. So if somebody was looking for a deal right now in your marketplace, what is like a duplex cost in San Diego right now? What is that number? So just to shock everybody.
Yeah, I mean, a nice area or a bad area?
Oh, that's true. I didn't know there was any bad areas in San Diego, but let's give me both.
Yeah. If you're looking at like a Class C market, like, the workforce housing areas, I would say anywhere between like 800 to $1 million. That's like a solid number if you're like looking like in the worst of areas. And then if you're looking in the best of areas, it goes up to like $3.5 million.
So what would the rent be on an 800 to let's say $1.5 million duplex in a C class area? What's the rent?
Yeah, so you would expect a rental income for that right around $4,000 to $5,000 a month.
Combined for each unit, or
combined for both? Yeah, both. Yeah,
man. I mean, but you can't even cover the
it doesn't work. Yeah, it doesn't work.
Great. You would have to come in with like 40% equity for that deal to make sense, right? I mean,
yeah.
Shit, like that. Well, that's shit, dude. Like, but
Yeah.
what about the reverse, the A class property? I mean, what's the rent for a $3 million duplex? What is rents?
That's even worse. I mean, if you look at it from like purely a cash flow standpoint, it's significantly worse. You'll be so negative if you put like 20% down. typically those duplexes, it's like usually owner occupants where they want to live in the front and like, have a little bit of income in the back to help offset their mortgage. But that's the kind of demographic that buys like really nice duplex in San Diego. And if you were just like purely buy it as an investor and you bought a $3 million duplex, I mean, you probably get like 15 to 20,000 a month in income, like if you're by the coast, but still, like it just doesn't work.
No, the economics, the ROI is the cash on cash, return on investment don't make sense. That's why I'm like, how does somebody do that? But that makes sense. I mean, I have a client in the San Diego area that does really well, and he's got a bunch of properties there, but he does really well because he's owned for years. That's that catch, right? Because I know the appreciation has gone up significantly in the last 3 years. But he tells me, yeah, like rents aren't as high as you would think in comparison to the buy, right? Like it just doesn't make any sense. The rents haven't increased significant enough to keep up with the cost or the inflation of the properties, right? So how do you make it work? Are you guys going into deals with more equity? Is that what you're doing? Is that the goal?
Yeah. So did you say our goal is to go and build more equity in a deal?
Well, go in with more equity to make the deals make sense. Like if you were, let's put your fund investor manager kind of fund cap on. If I went in to go in a deal with you, how do you make the deals make sense? Like, are you able to build super cheap? Are you looking for land that's amazingly cheap? How does the economics work? Because it sounds to me like it just doesn't make sense. Like, tell me how it makes sense.
Well, here's the thing. I'm telling you, fair market value pricing or, retail pricing. Retail pricing in San Diego never makes sense for someone who's looking to grow quickly. You will, if you bank on appreciation, you'll do fine because we've had more appreciation than arguably any other market in the U.S. But we, as investors, myself, we're always buying properties at least, 30% below market value. So I'll give you a quick case study. Like I bought 2 fourplexes in 2021 for $1 million. I sold them. I put like $250 into each of them, and then I sold them for $2 million each. One was 1.9, one was 2 million, and I exchanged it into a 16-unit building near San Diego State University. So the upside potential is massive if you buy right, but the cash flow can be great, but it takes some years to catch up. But you can build equity and double your money very fast in this market if you find good deals.
Yeah, that makes a lot of sense. Just the appreciation. So if I did my math right, you're saying you cash flowed. It was at $1 million each property when you bought them, or $1 million combined?
Million each, yeah. So I was like, I was into the properties total for like $2.5 million after rehab costs, and then I sold them for like $4 million. So yeah, I was up like $1.5 million.
Oh, okay, that makes sense. $1.5 million, got it. That's pretty damn good, dude. And you rolled that into it with a 1031. Let's talk about that. How many of your clients and yourself are using 1031s right now?
It's slowed. I mean, the market as a whole has slowed down for the investment market where I am. But I mean, if you're talking to me 2 years ago, I mean, everyone was, swapping like crazy, 1031ing, selling, buying, trying to take advantage of the good rates. So now it's slowed down, but most of the clients I work with, they want to do an exchange of some sort. Most people don't want to cash out. So it's still very popular, but there's less transactions happening right now in my market.
Really? So you feel like your market's slowed down like 20%, 30%, 40%? Let's say in the last 12 months, how much has it slowed down?
Yeah, I can give you the exact data because I track it. So on CoStar, like this year compared to the peak, I mean, we're down over 50% in transaction volume.
Interesting. Yeah. Does that not make you does it what does that actually do to you to make decisions now? What does that make you think about? Like what are you thinking when you hear that data?
Yeah, I mean, when I hear that data, I'm always an optimist. Like there's still deals going on every single day. Yes, I won't, do as many deals, but like slow markets, down markets, that's when like the biggest companies are built. That's when the most opportunity occurs. So I'm taking it as a positive thing because a lot of people in the industry are exiting, are, not even sharpening their pencils at all anymore. Young people are getting out of the business. Old people are retiring. So yes, there's less deals, but there's also less people searching for deals and trying to get the business. So I'm actually, not pessimistic at all about it. So my decision making, to answer your question, it's just made me be more disciplined, focus on key relationships much more, because relationships in the end are what create transactions. So I'm very heavily focused on building and fostering relationships, and then just putting in the work and being consistent every day.
Interesting. That, by the way, that's wise words. Anybody listening to that, wise words are the relationships. Those will supersede any market. The relationships go beyond markets and conditions and things. So are you finding now that you're saying transactions or volume is coming down, which is I can see too is very significant. Do you, from an investor standpoint, finding investors to come into deals with your fund or your projects, is that slowing down?
I would say a little bit, but nothing substantial. I mean, people are still. I mean, we just bought a like a $6.7 million portfolio here, and we were oversubscribed in like less than a week. So if the deal is good enough, we have the relationships to still have partners invest. But we're being extra picky because we know that if the return isn't absolutely incredible, that people are going to be a little too fearful to consider putting their money out right now, just because it is an uncertain market. So if it's a home run, no, but if we're buying a base hit, then probably it'll be tough to raise.
Are you giving prefs on these deals, or are you just they're coming in and expecting to bet?
Yeah, we give an 8 to 10% preferred return, and then
averaged out though, right? Not annualized, right? Averaged out on the exit. Is that what you're saying?
No. So the 8% pref, that is compounded year over year. So if we don't pay the 8% pref to the investor, it compounds to the next year. And then
I got you. That's what I mean. You're not making guaranteed payments. You're just doing it prep to the exit.
Yeah. Mm-hmm.
Okay. Well, I mean, that makes sense. I mean, I'm assuming that property that you're talking about had some capital expenditures, right?
Every single one we buy. Mm-hmm.
Yeah, I would imagine so. So probably they won't see money for 2 years, but when they do, yeah, that's when the exit's 3 to 5 years, I'm assuming.
Yeah, usually.
Okay, well that's cool. And so, subscribers. So you're saying you're primarily syndicating. Is that what I'm hearing?
Now, yes. At this point, yeah.
Were you doing like fund before, or are you just
never had a fund. Before it was just me and my partner putting in our money 50-50, money made from our businesses. So it was just me and him.
Well, that's by the way, but I think everybody should start that way in some respects. If you want to, not necessarily, if you have the time, that's a better way to say it. If you got time and you got a little cash, you should be doing that. If not, you should put money into deals like with Jason and make sure that you're going into something that's good. I don't think California is a bad market to invest in, by the way. I actually think it's a great market, and just the numbers still have to make sense. So I don't even know how you're making shit make sense, but apparently you are. Just guess you make magic happen, bro. It's weird. What are you guys on that? You said 6.7. What's the exit? How much do you think you are going to come out of it?
So the exit is going to be, that's actually a really quick flip. But that one, it's 3 properties. For the 2, it's going to be about $750,000 gain on those 2 properties, and then on the one larger property, the total gain will be about $600,000. So we'll be up net profit about $1.35 million.
And are you heavily leveraged? So I'm assuming you're just coming in with
heavily leveraged
20%.
We were pretty aggressive because they're really good deals, but we came in at 15% down with hard money.
Well, okay. So who financed that? That's interesting. 15%. Who financed that shit?
So one of my good partners and friends down here started out as a client in brokerage, but he runs a hard money fund full time. So he has a private money fund, and he really trusts us. He never does that with most people, but he trusts that we're good operators, so he gives us really good leverage because of the relationship. But usually it's like 25% down.
Oh yeah. That's what I'm wondering. I'm like, shit. Let me call that guy. No, I wouldn't. Honest truth, if I were doing deal, I mean, I am doing deals. We wouldn't do anything less than 25%, even if we could, because we need to have some equity in case of a market shift, right? We have to have enough cushion in the game to be able to make the deal work. But if you're doing a fix and flip, by an example, that would make sense. Like a 15% would be great, so you don't have to come in with a lot of cash. That's super cool, actually. So you're typically coming into these deals looking fix and flip kind of style, 3 to 5 year exits. This is really good. And by the way, anybody watching this and you're thinking like, is this like normal? Most of the terms we're talking about are very standard terms. I mean, there's nuance in between here. He's guaranteeing an 8 pref. That's pretty significant, by the way. That's higher than most markets. Usually you're looking at a 6 or a 7. 8, 9, those are pretty high. So congrats, man. If you can guarantee that kind of return, I mean, that's pretty impressive. So let's kind of transition as we wrap up here today and kind of share with me, I guess, the end goal for you. So like if I was trying to be a partner of yours, come in with some money, I mean, what's your end goal? I mean, do you have something set up that you're thinking big picture for you where people can invest with you for generations to come because you're going to build something? What are you thinking?
Yeah, I mean, I get a lot of it's really fun, and I get a lot of fulfillment out of investing with friends and people that I've met through the business and out of the business, like just out and about in San Diego. So I think just building partnerships and growing together and helping other people grow their wealth and me growing my wealth is just, I like building. So yeah, that's my path to really focus on for the next 30, 40 years, rest of my life. So yeah, we're just gonna keep chipping away every single year, being consistent. We're never gonna, try to rush things. In real estate, slow and steady wins the race. So we never take on more than we can handle. But yeah, we just want to steadily, build wealth and, build more fruitful relationships with our partners.
That's really good. What does wealth mean to you?
Wealth to me, man, when I think of wealth, it means freedom. Like, I think, for my family at least, money was always the biggest argument factor, always the biggest question mark, always the biggest anxiety creator, stress creator. So I think having wealth just means being free of those things. And when money isn't your primary motivator and your primary stressor, I just feel like life, can be so much more open to new things, whether it's following your passions or, giving back or just, building your schedule how you want. I think that's the true definition of wealth. But also wealth is also, I think, giving back in the form of education, form of charitable events. I think people who are fortunate, who have the opportunity like me and you to be wealthy, I think the ultimate goal is to give back and, keep it going.
That's beautiful. Well, the truth is what you're naming is kind of capitalism, right?
Yeah.
I mean, most people wouldn't consider freedom capitalism, but it is. I mean, it's our choice to do what we want with our money and to give and to be fruitful. By the way, I share the same values. I don't believe that we do anything just for ourselves. I think we have to be selfish in the pursuit because, I mean, that's the only way we can do good for others is if we do good for ourselves. Can't give what you don't have. And then and you can see that in almost every super successful, by definition, in real dollar wealth person, their passion becomes contribution as they age, rather than the pursuit of the next mission or the next dollar. It's more like, how can I impact the world through what I've done, right? And that's really cool because the educational piece, by the way, is a very fundamental thing that most people neglect. It's really good to give to your church and your community and your family, but the way I usually kind of envision this, and I'm writing my new book called The Escape the Rich Trap, and kind of the premise at the end, we get into kind of transition of generational wealth. And a lot of people miss the step that you're supposed to teach wealth, not transition it. Because if you don't teach it, the person that gets it just becomes rich. And rich people seldomly keep their money. I mean, rich people don't know how to manage money. They use the money to enjoy life, the YOLO mentality, and then they're out, right? And so I think the transition of wealth isn't transitioning money. It's teaching the wealth habits, and the process of becoming wealthy is the transition of wealth. And very few does that ever happen. And that's why you see like so many big names that you can know from, generational stuff, the Rockefellers of the world or the Carnegies of the world. those guys transitioned wealth to a generation that didn't know how to handle it, and then they transitioned to another generation that didn't know how to handle it, and so their billions are now just millions, and eventually they'll be nothing because they don't know how to handle it. They just never were taught the principles. And so I think what you said is key, man. And if you're at this age, you know, figuring this shit out is really cool, man. Like, to see you grow is going to be cool. So if anybody wanted to work with you, how could they contact you?
Yeah. Best way to contact me is DM me on Instagram or LinkedIn, just at Jason Joseph Lee, and happy to talk to you and work together.
Cool.
Thanks,
man.
David.
Yeah, send him a DM if you guys are looking for some properties in the Southern California area. He's the guy to go to. In addition to that, if you're looking to invest, not only along with your own money into your own deals, maybe you want to invest alongside him, you can always do that. Now, for those of you who need some tax strategy, don't listen to him. I got you. And
Agreed. Completely agreed. Do not listen to me about taxes.
yeah, don't listen to this guy. But he definitely knows about real estate, I promise. So, Jace, thank you, man, so much. It's been a great talk, man. Thank you.
Thanks, David.